Hello and welcome to another edition of BCR Webcasting. I'm delighted to be joined today by John Omoti, who's Vice President Supply Chain Finance at the Bank of China London branch. John will be speaking at our forthcoming Receivables Finance International convention, which will take place on the 23rd and 24th of May in London at the offices of Clifford Chance. And John, welcome. Your session at RFIx is entitled "The SCF Market Bigger and Better or Bubble," and I've just got some 2 or 3 questions to ask you in the lead up to that session at RFIx. Some questions about the SCF market in general, and my first question is a very broad question for you, John, and that is, what do banks get out of SCF? Because, and the reason I'm asking that is because um, most comments I get from banks about SCF products are that the margins are very fine, and they're quite costly to put together, um, and operate and run. What do you see as is it a loss leader? Is it cross-selling opportunities for banks, or is it a profitable product in its own right? How do you see it?
Yeah, supply chain finance is definitely profitable for banks. I think it's not just because of the profit, but because it provides a mutual beneficial solution for all counterparties involved. Both the funders, the buyer, the supplier, and sometimes the fintech partners who are involved in most of the supply chain today. They are all beneficiaries of supply chain finance. And that's why it's not surprising that over 80% of global trade today is being funded on open account basis, and supply chain finance is a key product to that effect. To banks, to your question, supply chain provides an opportunity for funders to unlock working capital for suppliers in the supply chain. By doing that, it provide them with early repayment of their invoices. By doing that, also improve their liquidity position, which allows them to run the business on a more continuous basis. For the funders as well, it gives them an opportunity to understand, know their customer, know their customer supply chain. So banks are able to plug it into their clients' wallet in terms of what they do, understand their business, and generate more better relationship with their anchor clients as well.
But it is a very competitive market, isn't it? So margins are very fine. Is that right?
It depends on the client. From experience, I've seen cases whereby the margins are very fine. The very large investment grade type of clients, they are very thinly priced, and some banks run some of those programs just to keep their books afloat, just to keep them active on supply chain. But they also have other type of clients, maybe lower investment grade or than to sub-investment grade space. The margins are equally very good. Once you have some form of additional risk mitigants, some form of insurance attached to them, those margins are a lot better, and it's profitable for the banks.
Okay, all right. I also want to ask you about collaboration with fintechs. This is something I think we're seeing more and more of. How much of that are you seeing within the Bank of China and generally, and what are the benefits to both parties, the fintechs and the SCF banks, of collaboration?
Yeah, collaboration is very much on the high. From what I've seen, based on our partnership with third party, I cover such relationship for the banks, and our number of fintech partners we work with is increasing year in, year out, and we've seen a few that offer different kind of solutions, and I think it has been very profitable. For one, banks are unable to compete with fintech in terms of the technology. They provide that technology platform, be it blockchain, be it AI solution, or be it any kind of emerging technology. Basically, they're very good at that, and they're able to adapt and improve on those. banks are unable to compete with most of those fintechs. But bank in turn, we have the capital, banks have the funds to be able to invest in some of those, some of the assets. So, and some of the supply chain we currently work with, you have the fintechs coming with technology, you have the customers, and you also have the banks. So all of us working together, it provides a win-win situation for all parties involved in the particular transaction. So for me, it's on the high, and I think collaboration is just the way forward. Anyone that doesn't do that, the person is basically not doing the right thing.
Okay, sounds like a match made in heaven. Are we going to see more of that? We're going to see the market for that kind of collaboration growing and developing and lasting for a long time. It's going to be an ongoing situation, I guess, is it?
It would be, based on what I'm seeing in the market. It's going to be an ongoing relationship, and it's going to get even better. Banks really might not really have time to adapt to certain changes. Clients have different appetites, which is evolving and changing year in, year out, and banks are unable to develop systems to meet those requirements. But the fintechs, on the other hand, have the time, they have the resources, they have the manpower, have the technical know-how to be able to adapt. So why not partner with them to handle those clients' relationships? Besides, the world is changing with so many changes, and everything is going digital. And so you need a strategic partner who focus on that digital space and allow the banks to handle the more aspect of providing capital.
Do you see banks attempting to acquire some of these fintechs in the future?
I have, I'm not mentioning name though. I have I know a bank who has acquired one, and
Of course, it's happened already to some extent.
It's I see that happening, but it's not compulsory you have to do that, but it's not impossible that can be done. Yeah.
I guess one of the advantages of keeping them separate is that the fintechs aren't subject to the same regulations as the banks.
That's very correct. Yes, that's very correct. Sure.
Okay. And I also want to ask you, John, about the new law that is coming in the UK on the digitization of trade finance documents, and also the Melita initiative, and the kind of impact that this might have on the supply chain finance market. I mean, is it going to, for example, is it going to have a big impact on the irrevocable payment undertaking, and perhaps being able to replace that with a digitized bill of exchange, for example, which would then mean perhaps better security for the funder, but also the opportunity to introduce new liquidity into the market by providing a secondary market for those bills of exchange. Is that the kind of thing that you see potentially happening here, or is there more than that? I guess there is more than that, but what do you see happening?
Melita, which is the model law for electronic transferable records, is to me it's a revolutionary solution which seeks to transform trade finance industry by providing that open framework for digitizing some of our trade finance documentation. One of the banes we've had over the years in trade finance is not being able to digitize our document. Trade finance itself is very heavy on document itself. And over the years, we've had challenges. Even when we try to digitize it, the legal framework which underpins those documentation within country to country, it's lagging behind. We've not had any legal support. So most of the time, most of those solutions that have come out over the years have been, you signed up to proprietary rule books, so to speak, within those parties. But now with the introduction of Melita, we're going to have a legal framework approved by that particular country, saying that yes, you could actually give those digital documents, or if it's a bill of lading, the same right, the same legal right as that of a physical paper document. I think that is revolutionary. I think that will greatly enhance supply chain or trade finance offering. It provides a lot of opportunity, Melita. With Military, you don't need to have a particular technology or blockchain or particular framework. What it does is allows you to transmit documents, even via email. It will be accepted on that, as long as the electronic trade bill is passed. I gather it's been looked into by the Parliament and hopefully will be passed around June. And I think once the UK passes this law, I think other countries will also begin to follow. But UK accounts for almost 30% of various jurisdictional laws. So I think that's huge. France, Germany, they're already looking at passing similar laws as well. You already have a few other countries who are already adopting those laws and are running with those ones. Bahrain, I think Singapore, and one or two other countries who are running with military already. So I think it's huge for us. It provides, as you said, on a platform to share bill of lading electronically, bill of exchange, promissory note. All that can be transmitted via an electronic platform.
Yeah. And I guess the advantages are lower cost, increase in terms of speed in producing these documents, and more accuracy as well, because a lot of mistakes can be made, of course, in paper documentation.
Yeah. Yeah.
Okay, so that should have quite a big impact on the supply chain finance market, trade finance in general, trade in general.
It would be, yes.
Yeah. Okay. All right. And John, just a reminder again, the subject title of your session at RFIx is the SF market bigger and better or bubble. So I guess we're not seeing a bubble that's about to burst, are we? In reality, we might see. We've seen some tremendous growth in this market in the last few years. That rate of growth has slowed slightly, according to our World Supply Chain Finance Report 2023. We're not seeing a bubble that's about to burst, are we? This is a long-term market with probably continued growth for some time. Is that your view?
That is definitely my view. I don't see supply chain as a bubble that would burst eventually. I don't think so. I think the growth will still be there. It's been growing year in, year out. And I think when I looked at your report, I think which is World Supply Chain Finance report put together by BCR, is a very impressive report, by the way.
Thank you.
We've seen still growth in all jurisdictions. Africa, Asia, North America, and also in Europe. They've all been growing, with the highest growth recorded in Africa and in Asia, which is no brainer anyway, because the volume of supply chain is still pretty low. So more people are beginning to tap into the market. You have other growth in North America and America, and also in Europe. However, it's been slower than that of last year, and it doesn't mean that it's going to get bust someday. It's just a bubble and get bust. I don't think so. I think it's going to continue to grow. It would only get a little bit slower with time when the market's fully saturated, especially within Europe. So we as a funder, we have to think of more strategic ways. That's why we look at in Bank of China a lot. We strategically partner with other banks. And we support them through risk participation and support fintech as well, funding some of their assets. So the market is going to be very saturated within this space. So we think outside the box and look for other ways to get more assets into the bank.
And that's one of the reasons why conferences like RFIx are important, because this market is developing and growing, and as you just mentioned, you need to think about how to manage these products in different ways as the market evolves. Well, John, thanks very much for your time this morning, and we're looking forward to seeing you. Once again, I'll just repeat it. It's Receivables Finance International, 23rd and 24th of May, at the offices of Clifford Chance in Canary Wharf, London. And yeah, look forward to seeing you there, John. Thank you very much.
Thank you. Thanks for having me today. Bye-bye now. Bye.